We begin with the third chapter of the course. In this chapter, we will talk about technical analysis, whose purpose is to provide tools and criteria in order to forecast the future movement of a stock. Whether we are going long or short, to choose which stocks to invest in, we can use the following two tools: technical analysis and fundamental analysis. Technical analysis, which is the tool we will see in this chapter, is an evaluation tool. It analyzes the historical prices of a stock in order to forecast its future movement. It is generally used for short to medium-term investment. On the other hand, fundamental analysis is a method of valuation. It analyzes financial parameters of the company where we intend to invest. It is generally used for long-term investment. Technical analysis is a tool that studies the historical prices of a stock in order to forecast its future movement. To do so, we analyze the stock chart and look for patterns to get buy or sell signals. Technical analysis is based on the following premises. The stock price includes all the information. Anything that can possibly affect the price, economically, politically, or psychologically, is actually reflected in the price of the stock. That is, the technical analyst does not focus on the information and news of the company because he assumes that this information is included in the price of the stock. The other premise is that the price movements are not entirely random, but rather they follow different patterns. In technical analysis, we must consider the following parameters. The first parameter is the one called support level or support. The second parameter is the one called resistance level or resistance. The third parameter is the one called trend, and as we will see later, it can be up, down, or sideways. The fourth parameter we must consider are those known as chart patterns. And finally, we must also consider the volume of the stock. Let's see the first parameter, support level or support. It is the price level defined by the lowest price, or a price close to it, at which a stock was traded in a specific period of time. Look at this. Here we can see the stock chart of the Amazon company, and basically we can see that around $160 is the lowest price at which the stock was traded. Precisely, the lowest price is indicated with an arrow that says test number 1. So, the price of $160 is support for the stock. Here, in another example, we can see that the lowest price at which the stock was traded is a value slightly lower than $27.5, and even the stock had 4 tests of that price. Clearly, this price level, close to 27.5, is support for the stock. It is important to mention that the more tests of the support level, the stronger it is considered. As we will see later, this is very important. Another parameter to consider is what is known as resistance level or resistance, which is the price level defined by the highest price, or a price close to it, at which a stock was traded in a specific period of time. As the support is the lowest price at which the stock was traded in a specific period of time, the resistance level or resistance is the highest price at which the stock was traded over that period of time. In this chart of the Amazon company, we can clearly see that for a price of around $244, the stock reached its maximum value. This value is indicated here with an arrow that says test number 1. So, we can say that the stock found resistance at this value. In this example, we can see that the stock had 3 tests of resistance at a price near $32. So for the analyzed period of time, the stock touched 3 times its resistance. As for support, the more tests of the resistance level, the stronger it is considered. We had said that another parameter to be considered is the trend. The trend is the direction of the movement described by the stock prices. Basically, there are 3 types of trends: uptrend, downtrend, and sideways trend. The first one, the uptrend, is when the direction of the price movement is upward. It is defined as a series of higher peaks and troughs, that is, higher highs and lows. On the other hand, the downtrend is when the direction of the price movement is downward. It is defined as a series of lower peaks and troughs, that is, lower highs and lows. And finally, the sideways trend is when the direction of the price movement is neutral. New highs or lows are not made. In this image, we can see an example of an uptrend and a downtrend. We can see the uptrend on the left side of the chart. All trends are demarcated by a line called trend line. In this case, since it is an uptrend, the trend line is ascending. The blue circles indicate the tests done by the stock on that trend line. We can see that both the highs and lows are higher as they are generated. On the other hand, on the right side of the chart, we can see a downtrend, and therefore the trend line is descending. Again, the blue circles indicate the tests done by the stock on the trend line. In this case, both the highs and lows are lower as they are generated. In this case, on the left side of the chart, we can see an uptrend demarcated by an ascending trend line. After the uptrend, we can see a sideways trend. In this case, along the trend, new highs or lows are not made. Sideways trends are demarcated by 2 horizontal trend lines, a lower and an upper one. Other parameters to be considered in technical analysis are those known as chart patterns. Basically, they are pictures or formations described in the movement of stock prices. We can distinguish 2 groups: continuation patterns and reversal patterns. In the first group, we have the formation called channel. This includes the uptrend channel, the downtrend channel, and the sideways trend channel. We have the formation called triangle, which can be ascending, descending, or symmetrical. And we also have the formation called wedge, which can be ascending or descending. Regarding reversal patterns, we can have the formation called head and shoulders, the one called double bottom, and the one called double top. The technical analysts that use the chart patterns as the primary working tool are known as chartists. Let's take a look at the first group, continuation patterns. They are transition patterns that indicate the stock will return soon to its current trend. Within the continuation patterns, we have the one called channel. This formation occurs when the movement of the stock is between 2 parallel trend lines, a lower and an upper one. As previously said, the channel formation includes the uptrend channel, the downtrend channel, and the sideways trend channel. In this case, we can see the figure of an uptrend channel, which is defined when the stock prices, represented by the red curve, fluctuate within 2 ascending trend lines. When the trend lines are descending, we have a downtrend channel. Finally, when the trend lines are horizontal, we have a sideways trend channel. Another formation of continuation patterns is the one known as triangle. It can be ascending, descending, or symmetrical. Right now, we are seeing an ascending triangle which has two converging trend lines. The lower trend line is ascending, and the upper trend line is horizontal. In this case, the stock prices, represented by the green curve, fluctuate within the mentioned trend lines. In contrast, the descending triangle has a horizontal lower trend line and a descending upper trend line. The ascending and descending triangles are also known as right-angle triangles. On the other hand, in the symmetrical triangle, the lower trend line is ascending and the upper trend line is descending. For all the cases, the point where the two trend lines intersect is called the vertex of the triangle. Another continuation pattern that we mentioned is the wedge formation. The wedge is similar to a symmetrical triangle because it is also defined by two converging trend lines. But what distinguishes the wedge is its noticeable slant, which can be to the upside or the downside. If the slant is to the upside, we have an ascending wedge. In contrast, if the slant is to the downside, we have a descending wedge. Now, let's see reversal patterns. They are patterns which indicate that an important change in trend is taking place. One of these patterns is called head and shoulders, which is defined when the movement of the stock prices is similar to the one shown here. In the figure, we can distinguish two shoulders, a left and a right one, which are practically at the same height. On the other hand, the head is higher than either shoulder. Another reversal pattern is the one called double top. In this pattern, the stock has two peaks at approximately the same level. In contrast, the pattern called double bottom has two lows at approximately the same level. This pattern is just a mirror image of the double top. Among all the patterns that we mentioned, we will focus on the channel. Right here, we can see a real example of an uptrend channel. Clearly, the stock prices fluctuate within two parallel trend lines, in this case, ascending ones. In any type of channel, the lower trend line is called lower channel line, while the upper trend line is called upper channel line. In this example, we can see a downtrend channel. In downtrend channels, the lower and upper channel lines are descending. Finally, here we can see an example of a sideways trend channel. As can be seen, the lower and the upper channel lines are horizontal. The last parameter we had mentioned to be considered in technical analysis is volume. As we saw in the previous chapter, volume is the number of shares traded in a specific period of time. In general, on a chart, volume is plotted below the price area. If we work with a daily chart, each blue bar of the volume represents the number of shares traded on the day. As we will see next, we will focus on the movement of the volume, in particular, detecting an increase or a decline in it.